What's up guys, Ben here and welcome to Motivation to Invest. Now previously I did a video on why I sold all my shares in my FTSE 100 index fund. And now I only invest into a few UK stocks. So in this video I'm going to reveal my top 3 UK stocks which I'm investing in right now. Be sure you guys watch till the end for a very special bonus stock. Without further ado, let's dive in. Kicking things off at stock number 3 is Rightmove. Diving into the share price for Rightmove, we can see pre-pandemic it was around 672 pence per share. It then plummeted all the way down by over 42%, so more than the broader market, but now has recovered massively and increased by over 67%. Rightmove is a property portal and website which is extremely popular in the UK. This is used by agents and people searching for property. It's used by agents when they wish to rent or sell a property and people when they wish to buy. To explain it simply to our US audience out there, imagine the UK version of Zillow. So when I'm investing, I'm always looking for companies with a competitive advantage. And Rightmove is one of those companies. Rightmove has a dominant market share of over 83%, so it's near enough a monopoly. There are competitors such as Zoopla, Prime Location and On The Market, but they have nowhere near the amount of market share as Rightmove. To put things into perspective, this is a similar market share that Google has on search. In June 2020, the company said the demand for its services had been very strong, and its platform had seen the 10 busiest days ever since May. Weekly email updates are receiving an average of 800,000 views, and the number of properties being listed is also rising, up by over 10% compared to the same time last year. And this makes complete sense. With people locked down in Q1 of 2020, they were dying to get out the house, literally, either to rent a new place, buy a new place, and even many people wishing to sell the place they're currently in. One of the major reasons that was listed for people wanting to sell their property or buy a new property is that they wanted a property with a garden. However, it's not all plain sailing for Rightmove. So Rightmove did report a 3.8% fall in its membership base to just over 19,000 since the end of 2019. This was partly due to agencies having a cash flow problems as a result of the health crisis. However, Rightmove has announced that it will continue to give discounts to agencies beyond the 75% offered from April to July. A 60% reduction will be given to customers in England in August, falling to 40% in September. While this should appease customers and the Rightmove agents, it's not great for Rightmove's top line. This support is likely to hit revenue from between 17 million and 20 million pounds. This is on top of the 65 million to 75 million already predicted. Right guys, so let's dive into the numbers now for Rightmove. So we're here on Stockopedia. For those of you guys that don't know, Stockopedia is the platform I use all the time on my channel to analyze stocks. I find it's a fantastic platform as every stock is given a stock rank and it's extremely useful. If you wish to check it out and see if it fits your investing style, I've actually got an exclusive 25% off discount link, which I'll leave in the description below, and it's exclusive only for you guys, the viewers of Motivation to Invest. So if you want to sign up to Stockopedia and see if it fits your investing style, I highly recommend you do this while the offer is still on. So diving into the numbers for Rightmove here, we can see it's a technology, balanced large cap high flyer, stock rank 70, momentum 76, value of 10, quality of 97. So great quality business, great momentum behind it. Value's not very good. So as it does have 83% of the market share, there is a lot of people bullish on this stock. Compound annual growth rate on the revenue, we're looking at 11.6% per year on average over the past few years. So around £200 million in 2020 is expected, which is a slight decrease from where it was in 2019 due to the economic conditions and support packages which Rightmove has had to offer. However, the company is a profitable business. This is not one of those businesses which is unprofitable. Net profit £106 million. An operating profit year to date £167 million. You're looking at fantastic margins there of nearly 70%, which does make sense as it's a website, it's an online business. It's not got major overheads like many of these other brick and mortar businesses. They also have an expected dividend for 2021 of 1%, which is not too bad. So yeah, looking at the revenue here, so it is forecasted to decrease for 2020 due to the issues mentioned, but then increase again by 2021, so rebound to 2019 levels, as is the net income and the earnings per share. Analyst consensus. So real mixed bag here. So we've got 8 hold, 4 buy, 4 sell, and 3 a strong sell. So there is quite a few sells in there, according to Credit Suisse, Morgan Stanley, a few other businesses there. Current ratio 2.35. Now that is fantastic. Generally, I look for a current ratio of at least 2. So current ratio is your short-term cash to your short-term debt. So it's basically how much cash does the business have on hand to pay off its debts due within 1 year. If it's got at least 2, it means it can pay off its short-term debts at least twice. So plenty of cash on hand, strong balance sheet. P ratio 36.6, which is fairly high. PEG ratio, which you could say is a price to earnings growth ratio, that's a 1.4. Yeah, it still does have a pretty high valuation considering the economic circumstances. So it's a real mixed bag with Rightmove. On one hand, we have the UK economy struggling, but on the other hand, we have a lot of exuberance in the property market. In addition, the government has actually introduced a stamp duty holiday from now until, I believe, March 2021. So some people, if they purchase a property this year, will actually pay 0 stamp duty, which is incredible. Right guys, so on to stock number 2 on my list, and that is AO.com, another online company which is benefiting massively from this health crisis. So AO.com is an electrical retailer operating in the UK and Germany. It specialises in household appliances and electricals. The company was founded in the year 2000 by John Roberts, and the UK head office is located in Bolton, Greater Manchester. It is listed on the London Stock Exchange and as part of the FTSE 250 index, which is the 250 largest companies in the UK by market cap. So AO has actually seen a lot of bullish momentum behind their stock, as Britons have actually been stuck at home and had to purchase goods from the online retailers. This was especially beneficial to the company in Q1 of 2020 when a lot of the major appliance shops were closed. The group expects its first half sales to end up around 57% higher than last year, which is incredible. The group said its sales momentum had continued despite bricks and mortar based rivals being allowed to reopen in the summer. Russ Mould, investment director at AJ Bell, said anyone working or furloughed at home only has to look out of their window to see delivery vans going up and down the road all day long. Years ago, buying a new cooker would have involved a visit to a showroom and a lots of chit chat. Now it's a simple check of the reviews and an order online in minutes. AO World said lockdown had triggered a shift in consumer habits, adding that it had seen a lasting step change in online penetration. The group's founder and chief executive John Roberts said that the last 6 months of trading have been like no other during his 2 decades in the business. AO was in good shape coming into this financial year, and the global structural shift in consumer behaviour to online has emphasised our strengths. Now, John Roberts, the CEO, I do actually like him. I've watched a Google talk by him. He talks a lot about artificial intelligence. He's very tech-minded in that he has a lot of tracking set up on his vans, on his delivery vans. He has a lot of automated customer service processes which help to increase the business's margins massively. So diving into the share price here, we can see in March, February 2020, it was around 73 pence a share, I believe that is, 60, 70, and then it's increased by over 450% this year, which is incredible, absolutely incredible. 450%, guys, just this year. So let's dive into the details for AO World. So technology speculative mid-cap high flyer. Stock rank 72, momentum 98, quality 78, value just 9. So it's up by over 400%. You're going to expect the value to be hit right now. But still an amazing business and definitely one to watch. Compound annual growth rate average over the past few years and the revenue is 17%. So looking at the revenues here the past couple of years though, we can see 2019, £903 million in revenue. 2020 year to date, £1 billion in revenue. By 2021 is expected to be £1.5 billion. So that's a 50% increase in revenue between 2020 and 2021, which is incredible. However, the company has been unprofitable the past few years and now is just starting to turn a profit in 2020, predicted to be more profitable in 2021. So with this business, I assume that they've been continuously reinvesting to grow the business. They've also been expanding to Germany, and that is why we see the company was previously unprofitable. So as you can see here, revenues forecast to increase 1.6 billion in 2022, net income 31 million to 36 million pounds in 2022, as is earnings per share. Three brokers here, so we have John Stevenson from Peel Hunt, 2 hold and 3 buy. JP Morgan we have here. So not too many analysts on this stock, which is usually when you can get the best deals. Current ratio 0.8, so that is quite low, to be honest, with that balance sheet right there. Maybe they're using debt to expand further. That is pretty low in terms of the cash on hand. Generally, I look for that to be between 1.52. This is a real issue with AO, and that is the PE ratio is extremely high, 48.2. If we look at the PEG ratio, though, so PEG ratio was popularized by Peter Lynch, and it's basically the price to earnings growth ratio. And the ideal is if you can get a price to earnings growth ratio less than 1, then it means that the valuation you're paying, i.e. the PE ratio, is competitive compared to the growth rate. So basically, a higher growth rate does indicate a higher PE ratio in general. But the PEG ratio helps you to find what's called GARP, which is growth at reasonable price. So this is a 1.1 on the PEG ratio, so not too bad as far as the growth's concerned. So if we look at price to sales, the price to sales is not too bad. So that's a 1.66, which is fairly good compared to the industry. So really, this business could potentially still be valued okay. So not in terms of profits, but in terms of revenues and sales. So if we look at the market cap today, so the market cap is actually £1.74 billion. But it's predicted to have £1.5 billion in revenue by 2021. So I still believe there's a lot more upside when it comes to this stock. However, just be aware, because of the way it has ran up so fast, that does add an extra risk, and there could be a lot of people trading this stock. Right guys, so the last stock I'm going to talk about is one I've mentioned many times on this channel, and that is stock number 1 on my list, which is Boohoo. So Boohoo is a fast fashion retailer based in the UK. They have websites such as Pretty Little Thing, Boohoo Man, in which they sell fast fashion. Now, I've done many videos on this stock, so I'm not going to dive deep into them in this video. But what I will touch on is their recent news. In a previous video I made on this stock, I actually made a healthy profit on a major trade I did. But still, I believe the stock does have room to run, especially when the UK economy and nightlife scene reopens. The major issue with Boohoo stock is investing in them is like a roller coaster, and you have to be ready to hold on tight. Taking a look at the share price here, you'll see what I'm talking about. So pre-crash February 2020, it was around £3 a share. It dropped to £1.60, which is when I actually bought it originally, so I got a great deal there. Shot up to around 100%. I sold some of my position, made a nice profit there. Then it plummeted again due to some factory scandal in Leicester, where one of their contractors was alleged to have been paid below minimum wage, but it was not directly part of the company. It was actually a contracted firm. So the stock crashed again on that news, but then it did recover by over 78%. And I made a great video for you guys, and I said that those that followed that recent trade, I give everyone a round of applause, as everyone made a nice, healthy profit there. However, then there was another roller coaster, another scandal hit. So the stock dropped again recently by over 30%. So the reason the stock dropped again was actually one of the auditing firms who does the accounting for Boohoo, PwC. They actually said they did not wish to take part in the bidding process due to reputational issues. And that is really the epitome of investing into a stock like Boohoo. Their fundamentals haven't changed. It has a great growth rate. It's a great business overall. They're benefiting massively from this global crisis. They're an online fashion retailer, but they have a lot of reputational issues. And when these reputational issues hit, the stock does plummet massively. And this does scare a lot of investors out of the stock. So really, it is definitely a stock you need strong nerves to invest into and to trade regularly. After the drop, I had a lot of you guys message me saying, Ben, is this over? It seems like it's panicked again. I told everyone, don't worry about it, and I was right again. So the Boohoo bosses snap up shares as value plummets. So the bosses have stepped in. Mahmood Kamani has stepped in like Superman, and he's bought 300,000 shares, lifting his stake in the company to 12.6%. And that's what I love to see from these founders of businesses. When their company is in trouble and their company is going through tough times, they don't run away, they step in and buy those shares. First, because they see value, and second, because they know their company is going to do great things. And that's what Mahmood Kamani has done right here. The senior directors of Boohoo have been buying shares in the fast fashion group less than a day after confirming that PwC was standing down as its auditor. So Mahmood Kamani, he had an average price of 243 pence per share, lifting his stake in the company to 12.6%. Now at 243 pence per share, I would believe that the stock is at a great value at that price, and that is a great average price to get in at. So be sure to check out my entire playlist on Boohoo stock. I'll leave it in the link below. But remember guys, this is not financial advice. Investing is risky, so please do your own research before investing into any stocks I mention on this channel. I'd love to know your thoughts on investing into the UK. Let me know in the comments below and I'll join in the discussion. Now, a lot of you guys always ask, Ben, which is the best platform to invest in stocks? And I'll tell you guys, I'm actually using a variety of different platforms at the moment in order to diversify my portfolio across account providers, as we saw that Robinhood actually got hacked. So be careful out there, guys. Diversify your risk across different accounts. A great one I'm using at the moment is eToro. They're actually sponsor of this channel, but there are a few other reasons why I like eToro. First is that you can do copy trader, so you can copy successful traders' portfolios, which allows you to get major gains. Second, you can invest in cryptocurrency, so you can invest in Bitcoin and Ethereum, which is quite rare for a free trading platform. And third, you can invest into ready-built portfolios and ETFs and all the major stocks we know and love. So if you wish to check out eToro, I actually have a special link. I'll leave it in the description below. Once you sign up and deposit, you can check out the platform and see if it fits your investing style. It's completely free and it does help to support the channel. And if you guys found some value in this video, feel free to give it a big thumbs up. That really helps out with the YouTube algorithm. And if you want more investing tips and exclusive stock market picks, which I'm personally investing into, then you should definitely subscribe to this channel and turn that notification bell on. With that being said, I'll see you guys in the next video. Invest safe.